Hello everyone, welcome back to my channel, The Tax Master UE. Today we are going to learn about transfer pricing. So before proceeding, please do like, comment and subscribe to my channel for more insights. So let's get it started. So transfer pricing basically is a tax concept which has significant accounting and risk implication. It simply involves setting up the prices when there is transactions between related or connected persons, and where these prices can be influenced by their relationship. And these transactions may include transaction of services, goods, intangible or financial dealings, and those involving a permanent establishment. So proper transfer pricing ensures compliance with the tax regulations and fair market practices. Generally, what happens when there is transaction with unrelated parties or independent parties, the price and other terms are generally determined by the market force and negotiations, which ensures fairness and alignment with the market conditions. However, when there is transaction between one related party with another related parties, these prices and the terms can be influenced by their relationship. This means that the related party may not use arm's length principle for deciding their price. They may use non-arm's length principle, which can deviate from what independent party would have agreed in similar situations. And due to that, pricing can be used to shift profit from one jurisdiction to another jurisdiction, and which will affect the overall tax liability of the group. This can be also done with an intention of minimizing overall tax liability. And by using this manipulative transfer pricing, related party can alter the taxable income reported in different jurisdictions and optimizing their tax outcome across the jurisdictions. And this is why transfer pricing regulation exists, which ensures that the transactions between related parties or connected parties should be based on the should reflect market based, using arm's length principle, and helps in preventing tax avoidance and using fair reporting. Now we'll understand arm's length principle. So the concept of arm's length principle is mentioned in Article 34 of the Corporate Tax Law, which requires that any transactions between related or connected persons should be priced at market price if they were conducted between as if they were conducted between independent parties in similar situations. This principle focuses on determining the price based on independent negotiation behavior using direct or indirect evidence. Also, the lack of formal pricing agreement does not exempt a transaction from arm's length principle. Suppose company A and company B, these two are related party, they don't have any agreement for the pricing for that any goods and services. With Even if they don't have any formal pricing agreement, they are not exempted from using arm's length principle. They have to use arm's length principle, because arm's length principle treats these parties as separate entities, which emphasizes which make them the need for making comparability analysis to evaluate controlled transactions against uncontrolled transactions. Under the UA corporate tax law, uh, re- related parties are expected to earn fair share of their profit, which with their entity recording operational profit that correspond with their specific role, assets, risks, and contribution in the arm's length prices. So the main concept of UA corporate tax law or transfer pricing law is that each related party should earn fair amount of profit based on their roles, assets, risks, or contribution applied for value chain. And here, this principle, arm's length principle, does not only apply to cross-border transactions, but it also applies to cross-border transactions as well as domestic transactions, which will promote compliances and equitable profit allocations. Let's understand this by with an example. Suppose company A is in a country where tax rate is 30%, sells 1,000 units of electronic goods at 50 per dollar to company B, which is in the low tax jurisdiction, so it tax it only 10%. And then company B sells that goods at the rate of $120 per unit in their country, in that country, and market price is $100 per unit, and cost to produce is $40 per unit only. Now let's scenario one. Arm's length, when they are using arm's length principle, in that case the profit of company will be, look, 100 is the market price, it means selling price, minus cost to sell is 40 per dollar, so net profit is 60 dollar per unit, and the unit sale is 1000, so 60,000 profit is there, and tax rate at the rate of 30%, so 18,000 tax for company A. And for company B, 120 minus 100 is equal to 20 per dollar into 1000 is equal to 20,000 into at the rate of 10%, the tax rate is on 2000. So total tax liability of the group is 20,000, and total revenue is total profit is $80,000. Let's come to another situation where arm's length pricing is not followed. Here they are selling goods at $50 only, so $50 is the selling price for company A, and cost to produce is $40. In that case, total in that case per unit profit is 10, 50 minus 40, $10 per unit into 1000 is equal to 10,000 total profit at the rate of 30%, it means 3,000 only. And for companies B, 120 minus 50 is equal to 70 into 1000 is equal to 70,000 at the rate of 10 is equal to 7,000 tax. So total tax here is only 10,000. However, the profit for both using arm's length principle or non-arm's length principle, 80,000, 80,000. The only change is that taxes. How they do? They just did by shifting the profit, more portion of the profit from high tax jurisdictions to low tax jurisdictions. That's how they reduces their tax liability from 20,000 to 10,000 only. That's why transfer pricing concept, that's why transfer pricing rule requires these related party transaction to be transacted at arm's length principle. So now we'll understand the scope of transfer pricing rule. So transfer pricing rule applies in the UAE for all the transactions or arrangement between the related or connected person. Also, like for company exempted or company who had opted for a small business relief, or company which does not have any related party transactions, they are exempted from maintaining or preparing transfer pricing documentation. However, they are not exempted from using arm's length principle. Even in that case, even exempted entities should apply arm's length principle when there is any controlled transactions. So now we'll understand what is controlled transaction. So controlled transaction is basically a transaction between related parties or connected person of anything, like any tangible goods, provision service, financial transactions, or use of intangible assets like patent or brands. And under UA corporate tax law, both UA corporate tax law or transfer pricing rules, both cross-border transaction, which is between the related party in different tax jurisdictions, and domestic control transaction, which is between related party within UAE, including free zone entities, must comply with the arm's length principle to ensure fair pricing similar to independent party. So how will we use arm's length principle? Here is the three steps. Number one step is that first of all you have to identify related party. Who are your related parties? And then is there any transactions between this party? If yes, you have to decide whether it is yes, transaction of sales, transaction services or goods. After that, we'll do, based on that service or goods, we'll do comparative analysis, and then we'll select arm's length transfer pricing method. Then for that goods and services, we'll use transfer pricing method, and then we'll determine arm's length price for such goods and services. This is how arm's length principle can be used. We'll understand the method of transfer pricing. So basically there are five methods accepted in transfer pricing law. Number one is comparable uncontrolled pricing method. So this is also known as COP method. In COP method, what we do, we compare the price of controlled transaction with the price of uncontrolled transaction. And if the price is similar, then the controlled transaction is considered to be at arm's length price. If there is significant difference between the prices, in that case, adjustment will be needed to align with the controlled price transaction with uncontrolled price transaction. We can see here with an example. Here company A, you can see company A, parent company is in country A, where tax rate is, where produces high-end smartphone, and subsidiary company in B buy these smartphone from parent company and sell them to the local retailer. Transaction detail now. Control price means related party transaction. It means parent company sells that smartphone to subsidiary company at AD $2,000, $2,000, and now we'll compare that independent by uncontrolled transactions. So retailer A sells that smartphone for 1,900 dirham each, and retailer B sells that product for 2,100 dirham. Now application of how can we apply COP method. Look, first of all, we have to check the price between parent company and subsidiary company is fair or not. So we'll compare that from independent party. So average price of independent sale is 1900 plus 2,100 divided by 2. So it will be 40 divided by 2. So 2,000 is the independent price of uncontrolled transactions. Now we'll evaluate that 2,000 dirham with our controlled transaction. Now here you can see here transaction here the price for controlled transaction 2,000. Now also price for uncontrolled transaction is 2,000. So we in conclusion, we can say that since the price of controlled transaction 2000 is same as the average price of independent sales, which is also 2000, it is considered at arm's length price. If the parent company charges subsidiary company significant different price like 2,500 dirham, in that case adjustment would be needed, which will align with the price with what independent retailer charges to ensure compliance with the arm's length principle. The other method is resale price method. So resale price method calculates arm's length price for transaction between related party based on the resale price of product sold to an independent party. The resale price is adjusted by adding the resale price margin and other transactions cost. And then resale price margin accounts for resellers operations expenses and desired profit considering the functional performed and risk assumed. We will also understand this resale price method with an example. Let's understand. Here parent company is based in country A, manufacture electronic gadgets, and subsidiary company in country B purchase that electronic item from parent company and sell them to independent retailer. So the price, so subsidiary company sell that electronic item to independent retailer for 1,000 dirham per unit. Now, after analyzing the market and considering operational expenses, subsidiary company determines that reasonable resale profit margin, price margin for similar transactions 20%, which will cover its cost and desired profit. So now we'll calculate resale price margin. So resale price margin is equal to resale price into resale price margin. So 1,000 into 20% is equal to 100 dirham. And the transaction cost for subsidiary company is 50 dirham for shipping and handling. So total cost, when we will determine the arm's length principle, so total cost arm's length, so total cost for subsidiary is 2,000 profit plus 50. So and resale price is 1,000. So while calculating arm's length principle, we'll consider all these two factors: one, transactional cost, and other, resale pricing margin. So arm's length principle price will be resale price margin minus transaction cost. So 1000 minus 200 minus 50 is equal to 750 is the arm's length price. On conclusion, using resale price method, arm's length price for electronic gadgets sold from parent company to subsidiary company is 750 dirham. This price reflects what an independent party would have paid for the product, adjusted for reselling operation expenses and desired profit. Therefore, if the parent company sells that electronic goods to subsidiary for 750 or higher, in that case, transaction should align with the arm's length principle. If there is a different for 1000 or only 5000, in that case, adjustment would have needed to reflect the arm's length principle. Other method is COP method. So COP, cost plus method. So COP method takes into account direct and indirect cost incurred by the suppliers in providing goods and service within the controlled entity, and then an appropriate margin is added to that cost based on the supplier's functions and the based on the supplier functions and the profit that would have been earned in arm's length transactions, and then the resulting figure after adjusting the cost plus markup to the supplier's direct and indirect cost will be regarded as arm's length price for the original transaction. Let's understand again with an example. Here, company A based in suppliers company based in A and purchasing company based in B. It buys machinery from suppliers company for its operation. So direct cost for company A: raw material 500, labor 300, other direct cost manufacturing overhead maybe 200. So total cost will be 500 plus 300 plus 200 is equal to 1000 dirham, direct cost, and indirect cost is 200. So total cost will be direct plus indirect is equal to 1200. And the markup in the while performing the market analysis, they came to a conclusion that market for similar goods for in similar condition is 30%. So markup amount, total cost into markup is equal to 1200 into 30% is equal to 360. Now calculating arm's length price. So arm's length price is equal to total cost plus markup is equal to 1200. Total cost is 1200 plus markup is 1500, 360. So total cost is 1560 dirham per unit. And in conclusion, if you see, using direct method, arm's length principle for the machinery sold from suppliers company to purchasing companies 1560. This price reflect the supplier's direct and indirect cost plus appropriate profit margin that would have been expected in similar transaction with independent party. If the supplier company sells the machinery to purchasing company for 1615 or higher, in that case it will assume that the transaction is at arm's length principle. The fourth method is the transitional net margin method. Here TNMM. So this method analyzes the net profit earned from control transaction relative to appropriate basis such as cost, sale or sales. Let's understand this again with example. Here parent company in country A, country B, subsidiary company, and the subsidiary company purchase furniture from parent company for 800,000 dirham and sell it for 1200,000 dirham, and cost incurred by subsidiary companies 300,000 dirham, which will include rent, salary and other overhead cost. So net profit calculation. Net profit is equal to sales 1200,000 dirham minus 800,000 dirham purchase price minus other cost 300,000 dirham. So 100,000 dirham is its profit. And net profit margin calculation. So net profit margin calculation is equal to net profit sales into 100. Here is calculation is wrong. You can see by net profit margin. So total net profit 100,000 divided by total sales. Total sales is total profit divided by total sales into 100%. So 100,000 dirham divided by 100 1200,000 into 100% is equal to 8.33 percentage. You can see. Now market research was that only there is 10 percentage profit margin from independent parties, 10 percentage for similar furniture sales. Now applicant TMA, how can we evaluate? TMA could compare subsidy profit margin 8.33 percentage with average net profit margin of independent company, which is 10 percentage. Now adjustment is required here. Since subsidy company's profit margin lower than market average, adjustment will be needed, and tax authority would suggest that the transfer pricing should be increased. Suggest that the transfer price should be increased, or subsidy company should find a way to reduce to achieve a net profit margin closer to market average rate. In conclusion, we can see that using this method, first of all, comparison return significantly low. In that case, adjustment needed. In this case, subsidy company may need to justify its lower margin or adjust its transfer pricing strategy, which will align with the arm's length principle. And other is the profit split method. Here, this method aims to determine how independent party would have divided their profit in comparable transactions. This method first identify combined profit of related parties and then split that profit based on their um, risks, assets used, or investment. Let's understand this with an example. Here, subsidy company, parent company in country A, subsidy company in country B. Combined profit is 1 million. Now, parent company is responsible for developing the software and incurred cost of 400,000, and subsidy company handle marketing and sales and incurs 300,000. So total cost for this company is 700,000, and net profit is equal to net profit will be 1 million minus 700,000. So 300,000 is the net profit. Now profit split. In here, this 300,000 will be divided into parent company and subsidy company based on their cost. So contribution is 60% for parent company and 40% for subsidy company. So parent share will be 300,000 into 60%, 180,000 AD for parent share, and subsidy share is 300 into 40% is equal to 120,000 per subsidy company. In conclusion, we can say using a profit split method, total profit of 300,000 from the control transaction is allocated between parents company and subsidy company based on their contribution. And parents company receives 180,000 while subsidy company receives 120,000 dirham. This split reflects how independent companies might divide their profit in a similar situation, which will ensure compliance with arm's length principle. If the profit split does not reflect independent with what independent would expect, in that case, adjustment may be needed, which will align to arm's length principle. So after understanding the method, we'll understand the what are the transfer pricing documentation. So as per article 55 of the corporate tax law, transfer pricing documentation, corporate tax law requires transfer pricing documentations for taxable person which involves in the transaction with related parties. Here transfer pricing documentation is nothing but simply a set of records prepared by taxable person which will show their compliance with the arm's length principle in connection with the related party transactions. Its main purpose is to provide FT, Federal Tax Authority, with clear and detailed understanding of taxable person transfer pricing policy and how they have been applied, which will allow FTA to access the transfer pricing outcomes for each relevant period under the review. Altogether, there are 5 transfer pricing documentation required by corporate tax law. One is transfer pricing disclosure form. This form will include the details of control transaction that occurred during the tax period. Here, every detail like who are the related parties, what are the type of goods or services sold to them, whether sold or received to them, amount we paid, whether we paid or received, how much amount we paid or received, and what are the transfer pricing method used to calculate that amount, and many more details are needed to provide in this transfer pricing disclosure form. Other is master file. This is a file which provides high level overview of the group businesses, including allocation of incomes and economic activities within the group. And this master file provision applies to only to a large business that are the part of multinational enterprises group with consolidated revenue, either consolidated revenue is 3.15 billion dirham, or taxable person's revenue is exceeds 200 million dirham. Similarly, local file. This file contains information on the local entities operation. Suppose in UAE, in that case, UAE is operations, local entities, UAE companies operations information is there. We need to provide in local file, along with analysis and testing the detail. And this also apply same like master file for any companies that are the part of MNE groups with a consolidated revenue of 3.15 billion or taxable revenue of more than 200 million dirham. And other file is report is country by country reporting. So this provide quantitative information on in multinational uh, enterprises group activities and income across different jurisdictions for the group, which has this applies to a company which has consolidated revenue of 3.15 million billion dirham per annum. And other is additional supporting information. So it will be provided whenever FTA asks for the any documents. So this is all for today. Thank you so much for watching. Please don't forget to subscribe, comment and like for more insights. Thank you so much.